Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Wednesday, the 21st of September, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. We'll go for our usual regular run through in here today, but it's going to be fairly quiet, fairly small, limited webinar, given that really there's not too much to focus on apart from the really big event, which is obviously the FOMC. So let's get that out of the way. So, we do have crude oil inventories this afternoon. So if you're trading oil, watching out for that. That's 10:30 Eastern. But then all eyes at 2 o'clock Eastern time on the Fed. So we also get interest rate projections in here. Going out further, and then we also get the statement, the decision, obviously, and the press conference. Then 30 minutes later at 2:30 Eastern time, all focus is going to be on here. We do get Bank of Japan, remember, overnight in here as well, and then going in tomorrow we get Bank of England. But let's focus on today. It's going to be all about the Fed. The other thing we do have in here, obviously from overnight, is that we have Putin gave a conference in here, spoke to the nation, to Russia yesterday, and basically kind of up the ante a little bit, mobilizing more troops, and also threatening any means necessary to achieve their goals. So obviously some concerns about that, but not a really big move. So dollar has rallied on the back of that. Dollar stronger as a safe haven, and moving back towards near record highs on the dollar index. Euro obviously negative on the back of that, because obviously Eurozone more impacted by what's going on in Russia Ukraine. It's been a while since Russia Ukraine has really notably impacted. We obviously had a week or so ago, we had the positive moves that were seen by Ukraine in claiming back territory, and that gave us a slight risk-on move over a couple of weekends ago. And this is obviously more of a negative, certainly for the euro, certainly for the in here for the and positive for the dollar, negative for European currencies and European markets to some extent in here, but not a massive impact on that. Obviously, with all eyes going onto the Fed on Fed Day. The market red flags that could prompt the Fed to slow down rate hikes. So credit spreads have been surging wider. This is important, 70% over the past year, and Treasury liquidity nearest worst since the pandemic. So these are kind of things that would potentially point to these credit spreads ending up blowing out as well in here. All of this pointing to potential. And these are things that maybe, I think it's an interesting article. I've only kind of read through it, but if you guys want to take a look, I'm putting it in the chat now. Take a look at that, because these are things, if you are into looking at what could trigger a more significant move from the Fed in here, default risk in here as well, rising default risk on. So this is the credit market and bond liquidity as well. So all of those things quite interesting and things to look at for going forward. Oil back higher today because of this partial mobilization of troops, obviously then putting negative pressures on potentially on supply. So then obviously oil higher. What else we have in here? Fed day, more in here. Fed set for big rate hike as waters get choppy for world's central banks. We know all this already, right? It's all eyes on the Fed. And pretty much anticipation in here of a 75 basis points. The stock slightly lower, bonds and gold gain. Again, risk off environment, Russia threats add to Fed jitters. The Fed are probably not going to react to that at all. I should imagine, I would be shocked. Dollar hits 2-decade high, makes another new high with Putin saber rattling pre-Fed. So all the same stuff in here. We do have UK have announced support for businesses. They previously, a couple of weeks ago, prior to the death of the Queen, announced measures for households to ease the burden of surging energy prices, electricity bills, gas bills, and they've now given measures for businesses as well in here. And just to see where we are today, going into today, so on the US side, we did have a notable setback. S&P just about made a new low yesterday. NASDAQ held the previous low that we had, but we're down about 1% yesterday. But we've had slight bounces in here this morning. And Nasdaq's pretty much unchanged, but we're up 0.1 on the S&P and Dow. On the futures markets, and European bourses in here slightly better. Even with that negative news, we have, DAX is pretty much unchanged in here. But if you look at French index, it's slightly better. Some of the other indices, about 0.25% up. FTSE is actually doing a little bit well. Remember, the FTSE is very energy heavy. So with energy up today, that's helping no doubt the FTSE higher in here today. And with the pound lower as well, that also helps the FTSE in here. Let's take a look at the Fed tool. This has been creeping up. So pretty much nailed on that we're only going to get a 75. Still an outside chance of a 100 basis point hike. I think that would be a huge shock for the market. It's all going to be about the narrative. How concerned. Obviously, the market's gone very much into risk off mode, and that risk off mode is being driven by the CPI data. How worried are the Fed? Are they going to downplay that data? Would they say, okay, there are inflationary pressures still? My view is they'll probably deliver a message that's somewhere in between, right? They're not going to want to get the market too spooked. They're not going to want to get the market thinking they're even more hawkish than the market is already pricing in quite a hawkish Fed. But then equally, they don't want to back away from the fact that there are going to be further significant rate hikes going forward. All right, so there's not really too much to talk about in here, guys. So obviously yesterday, as I said in here, Nasdaq didn't make a new low. If you look there on the daily, where if you look at the S&P, we did make a new low yesterday, but we've had a slight bounce from there. We had a bounce into the close, and the market dipped and bounced in here this morning. So trying to hold in, but it's all just going to be trigger levels around the Fed, right? So let's just take a look at what some of those trigger levels might be. So here's the S&P 500. Yes, we did make a new low in here just. In here, you see that we've got almost a quadruple bottom. One, or actually you can see there's 2 points here. So 1, 2, 3, 4, potentially 5, even 6. So this kind of area here is holding really well over the last week. But it's no surprise that the market has gone down and held. We're not going to get a more bearish statement or a more bullish statement ahead of such a major event. So we often get these potential bottoming patterns or reversal patterns form ahead of a major event. It's no surprise. This is not the market telling us it wants to go up. It's telling us it doesn't want to go further down ahead of the big event. It's not saying it necessarily wants to go up. But there are some slight signs of positivity from this potential basing. But it could just be, if we zoom out a little bit, you could view it equally as that this is just a flag pattern from this sell-off here, and this is an even bigger flag pattern from this sell-off here and this sell-off here if you go to the 30-minute chart. So you could just argue that this is just a pause before the next big down leg. I mean, I don't think, for me, it's just you just react to the Fed, right? I mean, there's no point really. But I mean, you've got some little trigger levels here. Just on the top side, we had 38.89, and then clearly the high up there, which is at 39. Where's that? 39, 36 and a quarter. And this peak over here, 38.93 and a quarter, 39.36 and a quarter on the upside. And I think just through the low here, through this low, if it breaks down through the low, then you're kind of short, right? And it's a similar story for the Nasdaq. Nasdaq holding in a little bit better. We go to the 15-minute chart. Again, look, you actually are starting to build higher lows, higher low, higher low, higher low, higher low. However, if you step out a little bit from 15 to maybe like a 1 hour chart, it's just kind of a flag pattern in here from this sell-off. And then you've got a bigger flag pattern from there's the CPI sell-off in here. So it all looks still fairly negative. I'd have to, if we weren't going into the Fed, I'd certainly be approaching this from a more bearish standpoint. This was a normal day. Obviously, all can change on the Fed. And I think it's a matter of just, you go with, you don't really oppose in here. You go with wherever the breaks are, and I think just through the lows in here, you do have this kind of tentative trend line here. Coming across the lows in here on the Nasdaq, because we have held the lows. So you have this trend line here. So if you want to get in a bit earlier, that trend line's coming in around 11,840. Somewhere there, if you want to have an early entry point in here on the downside, but you just got to be very careful, obviously. In here on the top side, if we take a look, you got this again tentative downtrend line that comes through here, and that's on the top side. It's going to come in near this peak in here anyway, so that's coming in around 12,030, and that peak there is 12,023, right? So maybe a little bit, 12,023 and a quarter. So that kind of area back above 12,000, 1250, 050 is more bullish. Down through this trend line down here, down through like 11,850, it's looking more negative from if you want to get early entry points breaking out from this triangle. Otherwise, you go through the breaks from the highs, the more recent highs and lows in here, these swing highs, swing lows. I would say it's reactive. It's all about being reactive, guys, in here. And I would say, generally, what happens with the Fed, the market doesn't. It's not too erratic, so it kind of just goes and then goes. So try it. I would suggest, my view would be don't try and be contrarian. You don't try and think, to oppose it. Go with. Okay, would be my view on that. Let's have a quick nod to the commodity markets because I know there are some of you guys who do focus on that as well. Let's zoom out on the daily here. first of all on gold. So you've had a little pop higher in here, even with dollar up. Okay, so dollar's obviously gone higher. Let's go to the dollar. In here, dollar did make a new high above the week high from a couple of weeks ago this morning on the dollar index. That would normally be negative for gold with the inverse relationship, but because it's such a risk-off event, the Putin news, okay, then we're seeing gold up with the dollar in here. However, very much the inside patterns, inside coiling in here. This has been more following stocks, okay, so risk again. You're just looking for breakout levels again in here, and it's going to be a similar, on gold in here. You're going to put the same kind of basing trend lines and breakout trend lines through here, and then maybe like through here. So you've almost got a flat flag pattern in there, sort of thing. So looking for those for breakouts in here on gold. I've got the wrong oil contract up. Where are we on oil now? LV. Let me add in oil. So I need to update. I think we're here, right? So that's the November contract on oil. If I go, first of all, I'll switch to the daily. So I will need to update this on my analysis, actually. But see the market again, choppy sideways. The bigger bear trend is still very much intact. We did have a decent hammer kind of pattern a couple of days ago, back Monday, and then the market held yesterday and then prodding higher. I'm still overall negative in here on oil, but you've got to allow for, again, breakout, right? So if we go to 30-minute chart in here, remember we've got the data ahead of this, so in here, and this looks more positive, but it is very much in a choppy range, right? Choppy range in here at the moment. I've got no strong view there going into today. Again, you go with a breakout on oil. Okay. All right, guys. It's going to be a tough one out there today. I would certainly suggest probably not trying to do too much ahead, pre-Fed, and then looking to see what you can do post-Fed would be my strong suggestion going forward, okay, into today. And I think on days like this with the Fed, it's usually fairly unambiguous. You can get some ambiguity, which the market can chop, but generally the market goes and carries on going. So try not to be that contrarian would be my advice, but take that if you want and leave it if you don't want it. All right, guys, going to wish you all a great trading day. Stay safe out there. And James or I'll be back with you with another Bull versus Bear. Probably James tomorrow, Bull versus Bear webinar on Thursday. Cheers. Take care.